Geopolitical competition has intensified in recent years, with significant shifts occurring among the world's leading economic powers. The United Kingdom, in particular, is rapidly developing strategies to strengthen its relationship with China, as both trade and security interests face growing challenges. Meanwhile, the United States is ramping up its technology control measures, specifically targeting China's semiconductor industry in an effort to curb Beijing's technological ambitions. In response, China has officially confirmed its withdrawal from U.S. public debt, signaling resistance in the ongoing economic rivalry between the two superpowers. These developments are reshaping the global order and creating complex challenges for countries trying to balance their economic interests with long-term strategies. Let's delve into these dynamics in today's video. But before we get started, don't forget to like, subscribe, and turn on notifications so you don't miss any updates from our channel. Now let's dive in. The global economic battle shows no signs of slowing as the world enters the new year. The West is reevaluating its strategic direction for 2025, while the new U.S. President Donald Trump is preparing for another trade conflict with China. The European Union (EU) continues to maintain a firm stance against cooperation with Beijing, yet countries like the United Kingdom, Italy, and Spain are starting to realize that navigating the volatility of the global economy is impossible without engaging with China. This marks a significant shift, especially considering the previously tense confrontations between Western leaders and Chinese President Xi Jinping at the G20 summit over human rights issues. The UK's stance toward Beijing has undergone a complete transformation, from a hardline approach to a move toward closer ties. The British Prime Minister is expected to visit Beijing in January, while Finance Minister Rachel Reeves is working to foster deeper economic relations between the two nations. This shift comes amid the ongoing impact of Trump's global trade policies, including tariffs and pressure on Europe to increase its purchases of U.S. oil and gas. These policies are causing significant economic strain, and the EU is concerned that the UK could be the next country targeted. In response to the pressure, UK Labour Party leader Keir Starmer is acutely aware of the negative economic impact that tariffs can have. He has emphasized the importance of avoiding such measures and maintaining sustainable trade relations with the EU, which remains the UK's largest trading partner. Over 42% of UK exports are directed to the EU, and more than 50% of UK imports come from the bloc, highlighting the undeniable mutual dependence between the two sides. However, the EU itself faces substantial challenges, particularly the prospect of importing costly energy from the US. This would not only drive up production costs, but also create difficulties for the economies within the bloc. The UK, meanwhile, faces dual pressures, importing expensive energy while striving to maintain its competitiveness in exporting to an economically weakened EU market. These challenges are further compounded by Brexit, which has led to an estimated £27 billion loss in export revenue for the UK since leaving the EU. Given these circumstances, it is essential for the UK to reassess its trade policies and forge new cooperative relationships. Nonetheless, in an increasingly volatile world, balancing economic interest with political strategy remains a significant challenge for the UK and the rest of Europe. In 2022, over 16,000 small businesses in the UK faced a significant setback, ceasing their exports to the EU. Data revealed a troubling trend, with exports from small businesses falling by as much as 40%, while larger companies fared better. Despite this, the overall decline in the UK's exports continues. In this context, the trade war initiated by the Trump administration risks putting the UK in a position where it can no longer rely solely on Europe as it once did. Additionally, the Trump administration's demand that NATO member countries increase their defense spending to 5% of GDP has imposed significant pressure. If most of these funds are allocated to purchasing weapons and equipment, it would offer little benefit to the EU or the UK economy. Meanwhile, the EU is grappling with its own financial difficulties, making stronger trade ties with the region increasingly unfeasible. As a result, much like other EU nations, the UK is now compelled to engage with China, an economy that is not only growing steadily, but also gradually distancing itself from the United States. Given this context, evaluating the UK's trade strategy becomes crucial. The United States remains the UK's largest trading partner, with trade volumes exceeding $100 billion. However, China is emerging as a key strategic player, ranking second among the UK's import partners, with a total value of $56 billion. China's supply of low-cost goods is essential for the UK, especially as it seeks to mitigate the impact of US tariffs. While UK exports to mainland China totaled $21 billion, adding Hong Kong's $10 billion brings the total to $31 billion, making China the UK's second-largest market for goods. The UK's reliance on the Chinese consumer market is growing, particularly as China develops its domestic market and decouples from the United States. This evolving relationship with China is critical for the UK, as it aims to secure its economic future in an increasingly complex global landscape. This situation presents a significant opportunity for the UK to diversify its trade and reduce its dependence on the US. By 2025, should the US impose severe trade barriers, increasing trade with China could become a crucial survival strategy. This shift is not coincidental, but part of a growing trend likely to intensify in the coming years. The UK is quietly undergoing a transformation marked by a strategic shift in its approach to global economic and political engagement, with a clearer emphasis on trading and investing in ways that align with national interests. Notably, discussions about China's support for Russia have been overshadowed by other pressing economic concerns, such as the decline of the UK's automotive industry. Amid this crisis in domestic car manufacturing, the UK appears to be seeking assistance from Chinese electric vehicle (EV) companies. The UK automotive sector is clearly struggling, with the historic Vauxhall plant in Luton, owned by Stellantis, of closure, a reflection of similar issues across Germany. Production costs in both the UK and Europe are rising to unsustainable levels, and the technology, especially in electric vehicles, is lagging behind China by several years. UK car production has fallen by 30% compared to the same period last year, marking the ninth consecutive month of decline. From a peak of 1.8 million vehicles in 2017, output has now dropped below 990,000 units in just 7 years. These challenges are compounded by the America First policies under both the Trump and Biden administrations, which have encouraged reshoring of manufacturing to the US. This has driven up energy costs for the UK and Europe, adding pressure on local industries. In this context, Chinese involvement in Europe's automotive sector may become a last-ditch solution. The year 2025 is projected to be turbulent for the UK economy, further emphasizing the need for strategic partnerships and innovative solutions. Meanwhile, another front in the global tech war is unfolding, centered on the semiconductor industry. The Biden administration continues to implement measures to curb the growth of China's chip sector, signaling an intensification of the chip war. Beijing is striving to dominate the global chip market, producing semiconductors for a wide range of industries, from cars and computers to weapons and household appliances. In response, the US has imposed restrictions on advanced chips and chip manufacturing technologies, particularly targeting companies like ASML and Tokyo Electron, to prevent these products from reaching China. However, this focus on legacy semiconductors has made China more vigilant. Currently, China controls over 30% of the global legacy semiconductor market, with this share expected to grow to 39% by 2027. Many products using these chips, including TVs, electric vehicles, and laptops, are predominantly sourced from China. China's growing dominance in chip manufacturing mirrors its capture of the solar panel market, achieved through cost reductions and increased production capacity. By 2030, China is projected to produce 50 million 12-inch wafers annually, surpassing the combined output of the US, EU, and Taiwan. China's robust growth has prompted the West, particularly the US, to impose trade sanctions to protect its competitiveness. These measures, including import restrictions and the economic isolation of Chinese products, aim to rebuild domestic manufacturing capabilities. However, the effectiveness of these policies is uncertain, as China continues to expand its global influence. According to reports, semiconductor companies are hesitant to invest in the US, largely due to Chinese suppliers offering chips at 30% to 50% lower prices. This price gap is attributed to China's supply chain advantages, including lower energy costs and control over domestic mineral inputs. Even the cost of shipping minerals from China to the US is much cheaper. In response, the US may impose tariffs on older chips from China, potentially ranging from 50% to 200%. This is seen as a necessary measure to protect domestic manufacturing, but it risks dividing the global market into two systems, one for countries that continue to trade with China, and another for those aligned with the US's increasingly protectionist policies. By 2030, electronics are expected to account for half of the total cost of a car, with electric vehicles using at least 3,000 semiconductors, including mass-produced chips. American consumers could face higher costs when purchasing cars due to the elevated prices of domestically produced chips compared to those from regions like Asia. This could trigger a global tariff war, leading to two distinct markets, one trading with China and another following US isolationist policies. As global trade undergoes significant shifts, the decline in transactions between China and the US could have far-reaching consequences. One such impact is China's decreasing reliance on the US dollar and its reduced dollar-denominated foreign exchange reserves. Currently, China holds a record low of $760 billion in US Treasury bonds, a $37 billion decrease from previous levels. Even if bond prices recover, it is likely that China will either allow these bonds to mature or actively sell them. This trend is expected to continue, presenting serious challenges to the US economy. Reshoring production to the United States remains a costly endeavor, especially with the Federal Reserve recently cutting interest rates and predicting only one or two more cuts by 2025. The Trump administration will face the challenge of issuing more bonds despite soaring borrowing costs. While G7 nations may continue to be net buyers of U.S. bonds, global demand is likely to decline as China strengthens bilateral trade ties with other countries. The U.S. Treasury yield curve is showing signs of instability, with both 2-year and 10-year bond yields rising, and the 10-year yield now exceeding 4.5%. This directly affects interest rates in the U.S. bond market, where competition is intensifying as China begins issuing its own dollar-denominated bonds. Demand for these Chinese bonds is nearly matching that of U.S. bonds, challenging Washington's ability to finance its debt, especially since China can borrow U.S. dollars at lower interest rates than the U.S. government. The bond market is undergoing significant shifts, with Chinese investors increasingly purchasing dollar bonds issued by the Chinese government to retain capital domestically. This is pushing yields on Chinese dollar bonds below those of U.S. Treasury bonds, as Beijing uses this strategy to reduce capital flows to the U.S. and intensify global capital market competition. These changes are expected to become more pronounced by 2025 as Western countries gradually ease U.S. sanctions and China seeks to disrupt the U.S. dollar system. The situation is becoming increasingly unpredictable, signaling a transformation in the global trade and financial landscape. In the months leading up to the U.S. presidential election, analysts have extensively debated how the winner could impact U.S.-China relations. In China, many believe that tensions with the U.S. will persist regardless of the election outcome. According to Beijing resident Loy, this view reflects a broad consensus across China, from policymakers to ordinary citizens, that every U.S. administration, whether Democratic or Republican, will aim to curb China's global rise, particularly in the economic sphere. During Donald Trump's presidency, the Republican administration imposed tariffs on hundreds of billions of dollars worth of Chinese goods and launched a campaign against Chinese telecom giant Huawei. In contrast, under Democratic President Joe Biden, the White House adjusted its tone, attempting to stabilize communications with China. Despite these stylistic changes, U.S. policies toward China have remained consistent, with President Biden focusing on the Chinese technology sector through investment and export controls, as well as imposing tariffs. Chinese analysts predict that regardless of who wins the U.S. election, a significant improvement in U.S.-China relations is unlikely. Looking ahead, experts agree that U.S. policy toward China is likely to remain unchanged. Shi Yinhong, a professor of international relations at Renmin University in Beijing, stated that the continuity of U.S. policy will overshadow any potential for major changes. Jin Canrong, Associate Dean at the same university, echoed this sentiment, saying that China will remain the U.S.'s main rival, with only tactical differences between administrations. In the U.S., both Democratic and Republican experts believe that a tough stance on China in trade matters will persist. Eswar Prasad, an economics professor at Cornell University, suggested that a victory by Donald Trump could exacerbate trade and economic hostilities, accelerating the decoupling between the two nations. However, even Vice President Kamala Harris could implement tougher tariffs, a step President Biden has already taken. Carlos Casanova, a senior economist at Swiss private bank UBP, noted that trade tensions between China, the U.S., and Europe are likely to continue, with a bipartisan consensus emerging in the U.S. for tougher measures against China. Recent surveys show that over 55% of Americans are unaware of the impact of trade with Asia, including China, on job creation. Only 30% believe that trade with China has created jobs in their state, and just 25% consider trade with Asia beneficial. Most Americans view trade as a zero-sum game, believing that other countries, particularly China, benefit more. Experts predict that during the next presidential term, U.S. economic policies toward China will remain firm, focusing on tariffs and efforts to restrict China's high-tech sectors, such as semiconductors and artificial intelligence. The main differences will lie in the methods employed, with Democratic administrations favoring targeted measures while Republicans may adopt more aggressive approaches. Chinese experts, such as Jin Canrong, acknowledge that U.S.-China relations have entered a phase of comprehensive competition, with confrontation becoming inevitable. As a result, China must continue to strengthen its domestic manufacturing sector, particularly in high-tech fields, while promoting the Belt and Road Initiative to secure a proactive strategic position in its rivalry with the U.S. During Trump's presidency, China took steps to prevent trade tensions from escalating. However, according to foreign policy experts, Beijing is expected to respond more assertively in the coming U.S. presidential term. One potential response could involve imposing heavy sanctions on select U.S. Fortune 500 companies, particularly in sectors where China can provide alternatives. Additionally, China might expand restrictions on critical mineral exports and implement other export controls. Beijing could also sell off a significant portion of its U.S. Treasury bonds. However, the most impactful move might be allowing its currency to depreciate further, which would directly undermine U.S. tariffs and complicate Washington's efforts to weaken the dollar and reduce trade deficits. Thank you for watching. If you enjoyed this content, please like the video and subscribe to stay updated with the latest discussions. Don't forget to share your thoughts below so we can discuss further. See you in the next exploration.